The terms company director and shareholder can get thrown around as if they are interchangeable, when in real life, they are actually completely different and have massive differences both on the protection you have and the taxes that you do pay. In this episode, we're going to talk about the differences between the two and how you know when you want to be a director or a shareholder. Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth. I'm Iannuzzelli, and today we're going to talk about the difference between a shareholder and a director.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
First, what we're going to discuss is about a director and what it actually means to be a director. A director is a person who manages the business, manages the day-to-day operations, from paying the bills to organising the work, taking care of the employees, ensuring that all the fiduciary liabilities are being met. And those fiduciary liabilities include making sure that you pay all the personal guarantees that you may have signed over as being a director of the company, making sure that all the employee entitlements are being paid as well, such as pay-as-you-go withholding and or superannuation. Now, a common occurrence that is happening around directors not paying employee entitlements is starting to become very much at the forefront of the ATO's mind. In the past, during COVID, we've been given a little bit of a grace period as directors, obviously going and suffering through a lot of financial circumstances that have occurred on the back of and during the COVID pandemic period. But the ATO has definitely cut the cord now. They've made it very short. And what that means is that if you as a director are not paying your employee entitlements, such as superannuation or building up significantly large obligations and liability for the company, then you can be issued what they call a director's penalty notice. Now, very important, a DPN for short, director's penalty notice, means that now the company's obligations and liabilities and debts are now guaranteed by the director, essentially removing that potential liability away from the company and imposing it on the director themselves. So it's very important. As a director, you have a fiduciary duty. You also must act in good faith and on behalf of the shareholders. The role for the director is to make sure that the shareholders are being taken care of, and that could be through higher profits, which relate to higher dividends, number one, or number two, that you're not running the business into the ground. In larger entities, it's very common to see shareholders actually taking action against the directors for bad things that they may have done or very bad decisions where they didn't have the shareholders' interest at heart or in mind. So it's very important. You as a director, when you sign on to be a director of a small business or a medium enterprise, you do not own the company. You are merely managing the company and making sure that all the obligations are being met. And again, trading with the interest that you're doing the right thing, the business is earning money, and the shareholders are getting very well looked after. Now, to move forward, looking at what a shareholder is. A shareholder actually owns the business based on their percentage, of course. They may own 100% or 50%. A shareholder has the right to the retained earnings, otherwise known as a dividend. A shareholder also has the opportunity to vote either a director into the business or potentially vote a director out of the business. Now, it is based on this special little deed called a constitution, and that constitution sets out the rules of the company. It sets out how many votes are required to vote out a director, or how many votes are required to potentially partake in a transaction where there might be a takeover or a sale of shares. So it's very important that when you become a shareholder, you review the company constitution. When you become even a director, you review the company constitution. A shareholder has that right of the business ownership. So very important. Director manages the business, shareholder owns the business. Now, a couple things that people unfortunately get wrong in the overall process. They want to be a director because they believe that they have all the managerial rights and also have a right to the profit of the business itself. Very important. You as a director, you do not have a right to the profits of the business. A shareholder has the right to the profit of the business. A director can issue the dividend based on what they believe the the working capital of the company needs to be and the retained earnings that can leave out the door. But a lot of people say, Jeremy, what should I be when I go into this company? Now, for many small businesses, unfortunately, you have no choice. You are the director, you are the secretary, public officer, admin assistant, employee, marketing, and also the shareholder in many circumstances. But when you start to get into joint ventures, many people request, Jeremy, what should I be in this particular business? And I say, well, what do you want from this business? And this could be, do you want to get involved in the day-to-day operations of the company, which means paying bills, the fiduciary duty that comes with being a director, making sure that you're part of the strategic direction of the business? Or do you simply want to be an investor? And an investor meaning a shareholder of the company. I advise the clients, are you going to be one of those people that's very heavily involved or take a backward step? Because remember, if you're not going to be heavily involved in the business and also become a director of the business, you're bearing that risk. So ideally, where possible, and this is a bit of colloquial term that I always say as an accountant, I'd rather be a shareholder but not a director. So it's very important you understand your role and what you want to achieve with inside that business, whether you want to be involved in the day-to-day operations, carry on the risk, or you simply want to be a shareholder responsible for receiving the retained earnings, but you don't necessarily get the opportunity to partake in the day-to-day operations. Now, if you've been listening so far, don't forget to hit that subscribe button if you're on YouTube, or if you're listening on iTunes and Spotify, don't forget to follow. You've got this far, so I just want to throw at you another term which doesn't often get used, but is very important as well. It's called shadow directorship. Now, you could not be a director on a piece of paper, but acting like a director. And that is making the day-to-day operational decisions. You are heavily involved in paying all the bills, talking to stakeholders. You're essentially running the company as a director would. Now, ASIC have this term called shadow directorship. This is where you are putting someone as a director, the figurehead of the business, bears all the risk, but really it's you, the shadow director, making all the decisions. If ASIC or the ATO or any other institution can create a connection with you acting as a shadow director, now remember, not on paper, a director not on paper, but a person doing everything that a director would do, then as a shadow director, you can also be pulled into line with the fiduciary duty that any other normal sitting director that is on paper would have. So it's very important, just because you may not be a director on paper or may not be a legal director that sits on ASIC documentation or the ATO's documentation, you still can be considered a director under a shadow directorship if you can be seen to be making all the decisions. So it's very important. Don't get caught in the grey area. If you're a director, you are responsible for the day-to-day operations. You do carry the risk of that business, and that risk could be through the fiduciary duty or could be through personal guarantees that you may sign. And as a shareholder, you don't necessarily carry the day-to-day risk of the business, but you do bear the risk of losing your initial investment. That is the money that you've put into the company, either through the purchase or acquisition of shares or the share capital issued. So it's very important before you start a company or before you enter into a company arrangement, you understand what is your role. Is your role simply to be a shareholder and to receive those dividends with not having the operational duties? Or are you a director, where you do have the operational duties of the business, the fiduciary duty as being a director, and obviously having the rights, responsibilities that come with being a director as well. Guys, if you get a chance, have a chat with your accountant, have a chat with your solicitor, make sure that you understand your role within inside the business and whether you're a director or a shareholder. Understand what you want from this business and how you're going to partake in this business moving forward in the future. This is what schools should have taught you. I'm Jeremy Iannuzzelli, and I look forward to seeing you on the next episode.